Wanted to take a look at TLT stock and, of course, TMF stock. These are the 20 plus Treasury yield ETFs. We had some data come out last week, important data that the Federal Reserve pays attention to. Plus, we also had the federal chairman himself making some comments. This moved the markets, the stock markets and the bond markets, which affected TLT stock and TMF stock, of course. But this week, we have two events that you want to kind of take a look at. Employment numbers in two forms. One of them I pay attention to a little more than the other. We get continuing claims and initial claims on Thursdays. And then this Friday, we get non-farm payrolls. This sets up what could possibly be happening for the following week when the Federal Reserve meets. We also have some other information coming in, ISM data, services data, which can move the market somewhat, but it's not one of the top tier as much as it could be during certain times. Nonetheless, it's going to be about employment numbers, and this could really move the market up or down, TLT stock or TMF stock, if the market believes that the Fed is going to do exactly what they say, leave interest rates higher for longer. If we get really strong, robust numbers for employment, bond yields would skyrocket, the stock market would fall. But what if we got really bad numbers in the sense that non-farm payrolls dropped heavily? That would send TLT stock likely up higher, but it would also probably send the stock market, SPY stock, the ETF, or the S&P 500, much lower. Let's break down what I'm paying attention to and how I plan on playing the week ahead. Let's jump in. Thanks for stopping by the channel. If this is your first stop by, make sure to hit that like and follow button. For all of you that have been following me, thanks so much. The channel's growing quite nicely. Thanks for the comments down below. It helps the metrics. We are now looking at PCE inflation deflator. This is the headline. It includes food and energy prices, which tend to be kind of volatile, and they sometimes lead the markets with other aspects. The core inflation, this is the number that people are generally focusing on the most. It came out last week. The stock market wasn't exactly cheering too much about this. Inflation tends to be a lagging indicator. You get employment gains that puts more and more people on the payroll. That payroll includes into personal incomes. Incomes grow at an increasing rate, so do expenditures. That turns into revenue for businesses. There's sort of a delay going on there. There's a delay in businesses hiring. There's a delay in consumers getting new jobs, increasing their incomes, and putting pressure on the system, creating inflation. So we are, and it works the opposite as well. So we are seeing some declines in the core rate, which does remove food and energy, not as much as the market wanted. It's still moving lower. Keep in mind, if you look backwards in time, from 1990 to about 1997, the Federal Reserve left interest rates pretty high. That's like a 5 to 7 year period of time when they kept things really ratcheted down. And I have a chart I want to show you on that. Here's the M2 money supply. And if you look backwards in 1990 to about call it 95, 96, 97, 98, right in that period of time, the money supply actually shrank. We had inflation. Then we turned things upward. Now, M2 money supply is what is really kind of accelerating some of this inflation that the Federal Reserve is trying to contain. There's too much liquidity. This is like nitro to the economy. And it's really driven by what the Federal Reserve does. They're trying to now shrink that. So it's not just inflation that they're looking at, it's also the money supply. When you shrink the money supply, this constrains businesses and it actually pushes interest rates up higher because there's a limited supply. So anybody who's looking to borrow money in a fractional banking economy, banks are going to lend to the best individuals first, most secure, if you will, versus someone who's teetering on the edges there. So it's a rationing mechanism for money. that would slow growth downward. So when the money supply does shrink a little bit, we're going to see that effect in the overall economy. Again, look backwards to 1990 to about 97, 98, somewhere in that period of time. M2 money supply shrank because the Federal Reserve kept interest rates as high as they did for so long. So if we continue to see inflation, if we don't see M2 money supply falling fast enough, you can expect the Federal Reserve will leave interest rates higher for longer. And this is really kind of the thesis that I've been playing on, that I believe that this is exactly what's going to happen. Thursdays, we get continuing claims and initial unemployment claims. Initial claims haven't been really robust. They've been steady, but nothing really eye-popping. In the meantime, continuing claims are moving higher and higher. So for those who have lost their job at this point, they aren't getting new jobs on a relative basis. Still a long way away before we see casualties with unemployment numbers and things like this. Nonetheless, this week's numbers for unemployment are going to be important. Here's a look at non-farm payrolls. It'll come out on Friday. The market's actually expecting about 200,000. That seems a bit high to me. If we breach 200, if we see revisions going backwards, which there's always revisions, if you actually go to the Bureau of BEA or BLS, any of those websites, there's generally preliminary numbers being released. We will get the preliminary number this month. They will revise the previous 2 months. So we always get those revisions. So it's not just this month that we're seeing. We'll see some revisions to the previous 2 months until they can get a better feel for what happened 1 and 2 months previously. If we see 200 and we see revisions upward, that could really spook the market. Now, continuing claims are moving higher. Initial claims, we go back to what I was talking about before, they're steady. So seeing non-farm payrolls print a decent number wouldn't shock me, but it'll probably upset the market. That's something to keep in mind. The bond yields would probably send upward. That would push TLT stock and TMF stock, those ETFs, much lower, real fast. Here's a look at TLT stock, the 20-plus Treasury yield price ETF. And we've seen some kind of backing off. After I guess it was Friday's comments, the Federal Reserve Chairman basically said that he believed the level of interest rate was at a restrictive level. And that's about all we got out of that. We pretty much knew what he was going to say. There weren't any surprises, but the market kind of took it and said, so no more interest rate increases. The market's actually kind of taking that back this morning. I've been playing kind of a too high, too fast, hit the brakes kind of thing. I haven't put any new positions on since Thanksgiving week. What I tend to do is sell options out of the money and just take premium. From time to time, I'll put on some kind of trade where I expect an actual position. My expectation is, and given this chart, what we're looking at, that we have seen sort of the bottom for now, but that what this move higher, and this is the 4-hour bar chart, which goes back a couple months, all the way back into September. You can see the damage that was happened in October. I felt October was a little too much, too fast, and I believe November is a little too much, too fast. I expect a range. I'm not calling for a rally. I'm not calling for a complete collapse. A range. When we see these moves, these pops higher, I tend to step in and sell calls against either TLT or TMF stock. If we were to see a big bottoming again, I'll sell those puts because it's probably too low. I expect a pretty steady, consistent rate for some period of time. I think the market has gotten ahead of itself. But I don't see a rally or a collapse. And it's just that range that I'm going to be playing. In the meantime, here's a much bigger look. I think the days of low interest rate environment are gone for some time. I don't see right now, I can't perceive any reason why the Federal Reserve would all of a sudden need to push interest rates sub 1% on the short-term rate, which would, of course would drive, say, the 10-year, 20 and 30 to a point where we go back upwards in TLT stock or TMF stock. We're about normal for price for bond yields, which would give us price. We're about where we need to be for now. I expect a range-bound situation. Maybe we see moves lower in Q3 with interest rates, assuming things sort of soft landing, employment shrinks a little bit. That would be the best case scenario. It would be a soft landing. I'm actually looking at two other scenarios. Number one, Federal Reserve never gets it right. Actually, that's the only bullet point. The Federal Reserve never gets it right. And it's not to say that there are a bunch of screw-ups, as much as it's to say is it's not exactly a precise science, and it takes time for any interest rates to actually move into the economy and give the sort of effect you're looking for. So the fact that they moved so much, so fast, really kind of makes you wonder, too much or not enough? They never get it right. They may need to step in and make some adjustments. What are we looking for? If we see employment gains all of a sudden plummet, guess what? Federal Reserve didn't get it right. They will back off interest rates. So TLT stock would, in that case, necessarily move much higher because interest rates are moving lower. The stock market would crumble. So that would actually be good news that is really bad news. The employment numbers just crashing hard. So much for the soft landing. The other scenario that I'm playing for is maybe we do get some kind of soft landing, but it's not enough. And the Federal Reserve has to ratchet up just a little bit more, 25 basis points, maybe 50 basis points. It takes time to work through the system, 6, 9, 12 months. So it may be that we're pausing right now just to see where we are. It will take some time. We may need to wait 9 or 12 months before the Federal Reserve says, you know what, employment gains just turned right back around. So did inflation. Remember, it's not falling fast enough. In that first period of the 1990s, interest rates remained high for a while. They really substantially shrank the money supply. The money supply right now, far too liquid. Interest rates are going to remain high for a while. We'll see how that plays out. It may be that the Federal Reserve didn't get it right. The economy U-turns, and then the Federal Reserve has to hit the brakes harder. Or it may be that the Federal Reserve didn't get it right. All of a sudden we see employment numbers collapse, stock market would crumble. Make sure you hit the like and follow button. Thanks so much for the comments. It helps out the metrics. The channel is growing quite nicely. Really happy about that. If this is the kind of content you're looking for, make sure to hit that follow button. What I do is I break down the economy and show you how it applies to the markets. We'll see you in the next video.